Hello, everyone, and thank you for joining us today. Uh, Over the past few weeks, markets have been navigating, heightened geopolitical tensions, which have introduced continued volatility across equities, commodities, currencies. Um, there are many questions that have been raised, given the developments that have been happening in the Middle East, and also in the broader sort of geopolitical landscape. Um, Now, these touch upon and cover, whether it's energy markets, inflation dynamics, or the outlook for global growth. So there are questions that we hear from both our clients, from our colleagues, from our families as well, many a times, whether it is at home and or from a different part of the world. Either we're on the phone or we're answering some questions. Uh, but there's something different that we're doing today. In today's session, we aim to unpack many of these developments and discuss what they mean for investors. And we will explore how markets have reacted so far, the implications of the events that are currently there across both asset classes, and importantly, I think how investors should think about positioning portfolios in the current environment. I think that's a broad agenda that we have for our session today. And to help me with this, we have with us Mr. Benjamin Jones, whom we refer to as Ben fondly. So, Ben, welcome here. I'm just going to give a little bit of an introduction. Hopefully, I do a little justice to it and don't butcher it completely. But Ben leads a fantastic team of incredibly diverse thinkers, many smarter than him, as he says, who
Yep.
aim to support Invesco's clients and investment teams in making the best investment decisions possible. His team provides and produces research content and insight into a broad spectrum um, for investors across the globe, covering both public and private markets. Ben has been with the firm since 2021. Ben, would that be correct? Yeah.
That's correct.
And he has been leading the multi-asset research efforts for the Henley multi-asset team and work closely with many multi-asset fund managers to set the core macro and markets overviews across the range. He's currently the global head of research as of October 2025. Um, from an academic side, Ben is a CFA charter holder, holds a master's degree in finance from the London Business School and a first class degree in economics from the University of Surrey. He is obviously, if he looks familiar, he's been frequently commentating on these subjects in the financial press. So, yeah, thank you for joining us, Ben, and being part of this session.
Thank you very much for having me. Appreciate it.
Yeah. Along with Ben, we also have Michelle Karkour, who is the client director for Invesco in the Middle East, a role which covers the distribution effort that he leads across Middle East and Africa, working with banks, private banks, insurance companies, to be able to sort of deliver a broad range of investment strategies across the markets. Um, he has been, an investment professional with over a decade of experience in the global asset management and distribution side of things. Welcome, Michelle, and it's a pleasure to have you here.
Pleasure being here as well, Anselm. Thank you for having us.
Of course, from Continental side, we have with us Mr. Sumit, who heads the investment function at Continental, and myself, Anselm Mendes, who's the executive director for Continental. And we are the ones who are going to be doing a little bit of the grilling for Ben and Michelle on your behalf. Just a sense of the webinar form and format. We have about 45 minutes that we've allocated to the discussion and conversations, questions that me and Sumit will be pouring in and addressing to Ben and Michelle. These are questions that have come in from conversations with you, from submissions from you. At the end, we've saved 15 minutes to be able to address any queries, questions that you have. There is a chat box below, so feel free to put in your questions in the Q&A box that you see, and we will look at addressing those questions in the question and answer session. If you're unable to get to your specific question, please do bear with us because there may be a set of questions and volume of questions that we may not be able to address. But rest assured, we will pick Ben's and Michelle's brains and respond to you with the answers with the email that you've registered with. So with that bit of hygiene out of the way, I am going to dive in to the webinar. The first thing and the first order of business that we have is actually a question for you, the audience. So before we get to Ben and Michelle or Sumit, we'd like to hear from you. And if we can pull up the poll, please. We've got a poll question for our audience members, and that should be coming up on your screen now. There you go. Hopefully everyone can see the poll question on the screen. Please feel free to answer. I'm going to read it out. What would be the most valuable for you right now from market experts? So is it a clearer view of likely scenarios, guidance on portfolio positioning? Are you looking for sector or asset class opportunities, risk management ideas, or help separating the noise from signal? Uh, we'll keep this open for a few seconds, so maybe about 10, 15 seconds. Get your answer in, and as soon as I have a cue from the team, we will close the poll and go to the results. So every one of you who's on the session on the call, please, we'd love to hear from you and get your inputs as to what you would like from this particular session. All right, I'm also going to vote if I am able to. Let's try this.
It says I'm not allowed to, Anselm,
Yeah,
but
I think
I would like
all these-
answers to all of those questions.
Yeah, it is interesting given the times that we are in. All of those questions, like you correctly said, are seem absolutely relevant. I'd like to hear the answers to
Indeed.
many of them. But yeah, I think what we want to sort of try and get from our audience is, which one is top of mind, front and center, and which one are they really, really anxious to understand and know more about. All right, do we have the results of the poll? There we go. It's up on the screen. So a little balance, I think, as we probably recognized, but the clear lead has been taken by sector or asset class opportunities. I love it. I think we've got an audience that is very eager to be able to sort of dive in and take advantage of the opportunities. So it's fantastic. That followed by guidance on portfolio positioning, two leading ones. That clearly sort of gives us a good sense of what the audience want to hear. Followed by, I think, a tie with a clear view of scenarios and risk management ideas, and then I think help separating signal from the noise. I think we've got an audience that clearly is very clued in. So I'll go to you, Ben, Michael, with my sort of first question. Sort of also ties in a little with the poll that we have over there. The recent escalation, and that's something that's front and center, and everyone has got that on their mind. So, in the geopolitical tensions, there's clearly unsettled markets. I mean, that's a no-brainer. From your perspective, what do you think are the key geopolitical triggers that investors should be paying attention to right now? And which of them do you think the markets are most sensitive to?
Sure. So thank you everyone for having me. Pleasure to talk to you this morning. I hope everyone is safe and well. In answer to your question, Anselm, I mean, it's very, very tricky at the moment. I think the first thing I just want to say at the outset is that anybody that talks about these events and the transition of where we go to here with an enormous degree of confidence, I think you should treat with a bit of distrust. We have to appreciate that there is two very, very big different outcomes that potentially could happen here, and we are dealing with personalities. So with that caveat out of the way, I think the challenge that we have at the moment, the thing we need to think about is how long this conflict goes on for. The duration is particularly important because it's the duration of this that is going to impact ultimately whether energy flows actually start to flow. And that again is the important bit for markets. So if we take a step back and think about geopolitical events in the past, many of them have had really no lasting impact on markets unless there is an impact on fundamentals, if there is a significant and prolonged supply shock. So the things that I'm looking at are very clearly, is the energy flowing out of the Middle East region? Are we seeing ships going through the Strait of Hormuz? And obviously, we're not really seeing that at the moment. Now, there are some guidance, I think, that I'm looking actually a little bit slightly further away from the region right now to help me adjust the probability of when those flows are going to start. And I would look over towards the west to the Red Sea. We've seen a US fleet moving through the Suez Canal recently into the top of the Red Sea, and potentially going to start to come through down the Bab el Mandeb. Now, the reason that I say that is important is because that fleet of ships is going to start to move down and pass through some of the Houthis. And if the Houthis attack those ships and we see damage there, that potentially means that the US is going to be far more reluctant to start to move ships through the Strait of Hormuz, which means we're then going to see tankers and containers and bulk freight reluctant to move through that strait as well. And if that happens, that is something that is going to prolong this situation, I think, and make it worse. And that's when you're going to get further upward pressure on oil prices, on gas prices, on fertilizer prices, for example. So at the moment, the thing that we're looking at is a lot of these ship movements and these military movements, and increasingly the volume of attacks that Iran can make to the region as well. Now, I think we've seen that a lot of the military capability of Iran from a ballistic missile and a cruise missile perspective has been neutered to a large degree, but the drone side of things is still a significant issue. And again,
Right.
the drone attacks, if they are on oil and energy infrastructure, if they are on ships in the Hormuz, that then again prolongs this event. So a lot of it is around the duration of what happens in the region. The one second thing I would say quickly is that we need to just also take a step back and look further out across the world, because if we can see supplies of energy picking up from other areas, so releases of strategic reserves in the US, for example, and that energy and oil and gas, for example, can get to market, then that can slightly ease some of those tensions. So things that we've seen overnight, for example, is that the US administration is going to waive the Jones Act. What the Jones Act says is that ports in the US can only be serviced by US ships when you're transiting between different American ports. If they release that, what it means is that non-US flagged ships can then move between these ships. That will then be potentially a positive in terms of allowing energy to come out of the region. So unfortunately, there are so many different moving parts at the moment that we have to really keep our eyes wide open to all of these at the moment.
Yeah, I think
Right.
makes a lot of sense. Sumit, sorry, you've got something. Go
Yeah.
ahead.
Sorry. Yeah. So thanks, Ben. I mean, that is pretty much is happening in terms of the geopolitical tension. You're
Yes.
talking about volatility, and you're talking about the impact across equities, currencies, rates, etc. And you also referenced previous, geopolitical setbacks. So what we are
Mhm.
seeing unfolding in the world right now, is this consistent with what we have typically seen with other previous geopolitical tensions across the world?
I think it broadly is. I mean, there's a few things here that some of them look a little bit strange in the immediate sort of start of this conflict a week and a half ago, or 2 weeks ago, nearly now, and certainly volatility, as you mentioned, has increased. What I would say though is, if you look at volatility across some areas, you would say volatility hasn't increased that much. Actually, US equities at an index level haven't moved to a massive degree. The US is still trading in about a 3.5% trading range over the course of 2025. So sorry, 2026. So relatively narrow. But some of those sort of index level moves that you see, I think, actually mask a lot of variation, a lot of volatility below the scenes. And actually, I think that was really interesting that the poll question you asked there was, or the answer to the poll question rather was, it's sector views that people want to see, because that's where we're seeing a lot more of the volatility, where things like energy performing better, semis and tech again performing better in the
Right.
US. There's been a lot of volatility, yes, in places like Korea, for example. Some European sectors have been hit very heavily. I think at the moment we are very much in the emotional state, and people are sort of processing what is going to be the impact on this. The
Right.
one also that is normally rallies very aggressively in this type of environment is the dollar. Now, it would make sense that the dollar should rally. It's typically viewed as a safe haven currency. The US is an energy exporter as well, so it's relatively more insulated from these types of events. But actually, the dollar's only up about 2% or so, and I think that again reflects this idea that there still is a bit of a degree of lack of trust in the US, and there's still a lot of policy uncertainty around the US at the moment. So the US dollar, although it's been the safe haven in the last week and a half to 2 weeks or so, maybe isn't quite the same safe haven as it would have been in previous types of geopolitical shocks, such as this. I think the other thing
Right.
that people are looking at as well is they're realizing that actually a lot of these times these geopolitical risks should be faded over the medium to long term. Typically what you see is a spike in oil prices, they come down quite quickly. Equities sell off, they rally quite quickly. So if we look back at some of these big geopolitical events over the last 50 years, what you tend to see is that global equities are higher and significantly higher in the 12 months subsequent. And I think there's a lot of investors that are looking at this and going, okay, now this is another opportunity to sort of buy the dip, to not
Right.
panic, to not sort of get out of all these areas en masse. And that's why in some areas you've seen actually volatility and the reaction is relatively well ordered, actually.
Right. So you just spoke there about the trust in the U.S. economy and the
Mhm.
policy angle there. Now, global energy chains have suffered major and unprecedented disruption, right? And you spoke about the Strait of Hormuz. That situation is very fluid, and we are not sure
Yes.
how that's going to evolve. Now, what knock-on effects do you see this could have for the bank policy expectations? In terms of inflation, interest rates, etc. How do you expect that to play out?
So this is a really good question, and this is one actually where I would say I've seen some moves in market pricing that I find somewhat odd. Because if we think about what this shock is, it's going to be twofold. Higher energy prices, higher oil price, higher gas prices, higher fertilizer prices are going to put upward pressure on inflation. The
Right.
upward pressure on inflation that we are likely to see in somewhere like the US and Europe and the UK, for example, if we assume that oil prices rise by $50 a barrel compared to where they were at the beginning of the year, that is likely to put upward pressure on inflation to the tune of about 1 percentage point. So a meaningful increase in inflation, but not
Right.
getting us into double-digit inflation. The growth impact then is going to be negative as well, because higher energy prices are a tax. It costs me more money to put petrol in my car. I don't spend money on other things. So there's a growth shock as well. It's the classic stagflationary shock.
Stagflation. Yeah.
Now, you say, what are central banks going to focus on? Are they going to focus on the inflation part, or are they going to focus on the growth part? Now, the market pricing that you've seen over the last week or so has been to suggest that central banks should focus on the inflation part of things. There, at one point at the beginning of this week, there were 2 rate hikes priced for the Bank of England and 2 rate hikes priced for the ECB. Personally, I think that's wrong, because raising interest rates into a stagflationary environment does not help the situation. That does not help
Right.
more oil get onto the system. It does not print hydrocarbons. Actually, what it does is it exacerbates the problem. And I think if we were to get those kind of hikes, that is something then that the market is going to take quite negatively. That is something that's perhaps going to trigger that sell-off, because it's going to accentuate the weakness in the growth dynamics. So I think that's something we've got to watch for. The only way that I can sort of explain why we've seen those increase in rate expectations is people are concerned about a repeat of the 2022 experience when we had double-digit inflation in the US, double-digit inflation in Europe. But we have to remember that was a very different situation in 2022. We were coming out of COVID, we had pent-up demand, households had an awful lot of money sitting, burning a hole in their pocket, and they wanted to spend it. The government was pumping lots of fiscal stimulus into the system, and inflation was already rising. As we came into 2025, inflation was coming down, particularly in Europe, particularly in the UK. So the setup is somewhat different. So I think again you're going to get these knee-jerk reactions in the heat of the moment, like we've seen over the last 2 weeks or so. But I do not think, despite market pricing, that the Bank of England or the ECB will hike rates into this environment, because it doesn't help. It actually hinders the situation that we have.
No,
Yeah,
absolutely
I think
agree. Thanks for that. Yes.
I think that's very interesting. I mean, you pointed out, and sort of just getting into it in previous. I mean, if you think about it, right, from a previous crisis perspective, the playbook was, I hate to use this word, but was probably simpler in terms of what we should be looking at and doing, right? Buy gold, U.S. equity, treasuries,
Yeah.
uh, uh, and now, I mean, of course, it's a lot more complex. So, has the transmission changed? I mean, where are we seeing the sort of clearest transmission of these geopolitical risks, if you will, across the asset classes?
Well, just to pick up on something you said there, I think is absolutely key. In previous events in the past, in really much of my 20-year career doing this, it was very simple to understand what the reaction function was going to be. It was that the central bank was going to cut interest rates, because a lot of the events that we saw were demand shocks on the system. So certainly 2008, for example, with the global financial crisis, certainly with 2020 with the pandemic, central banks cut rates, flooded the system with liquidity. It meant that bonds were the diversifier in your portfolio, because yields went down and prices went up in that scenario. Now, the problem with this type of event, and the event that we saw in 2022 as well, is that it is a supply shock. It is not something, as we discussed, that central banks can necessarily respond to in exactly the same way. So we need to think about portfolio diversification very differently, in my mind. We need to think about what we do when those correlations between bonds and equities are positive. And this is something that Sumit and I spoke about a few weeks ago when I was in the region with her, and we recorded a podcast together. You need to think about your longer term portfolios in a different way, I think, now. And everything that's happened over the last few weeks or so has just confirmed that. So what it means is you want to build different, more resilient portfolios. Yes, you have equities in your portfolio. Yes, you have fixed income in your portfolio from a fixed income perspective, but you need other alternative assets that are more sensitive to inflation, that can hedge you against that inflation risk. Now, that can be things like commodities. It potentially can be things like real estate. It can be just other alternative assets as well in the portfolio. We won't go into detail on them, but just essentially cast your net a little bit wider and think about the risks that you are trying to hedge against at the moment. I'm not sure if that answered your question, because I sort of slightly went off on a tangent. Did I answer the question?
Yes, I think it does.
Okay.
It gives us a little bit more clarity in terms of how we can look at it in a complex situation like this. And thank you for that. I think just a reminder to all of our attendees, there is a question and answer box that is available for you to pose your questions if you'd like to sort of get some insight from Ben or from Michelle or from any of us here on the webinar. So please do go ahead and type in your questions, and we'll get to it at the end of that. In the meantime, I'm going to ask you another question. We've got a poll coming up. So the poll should be coming up on your screen shortly. And the poll question, there you go. It is which market risk linked to the current geopolitical developments concerns you the most right now? And you can select multiple choices in this one. So if your heart says that all of them, then you could go ahead and select all of them. But the options that you've got are the equity market volatility, oil and energy price spikes, inflation staying higher for longer, supply chain disruptions or currency moves, that is essentially FX instability. So we'll give you a moment to be able to put and lock your answers in. Yep, curious to see where those goes. Ben, Michelle, any comment on what your sort of pick might be?
Again, sort of all of them, I would say are important, but probably the currency moves and FX instability, I think, is an interesting one. And then whether inflation stays higher for longer. Again,
Yeah.
as we've talked about previously, I am more concerned, and I was more concerned about inflation coming into this year than I think most people were. And now the challenge for me is I've been, I guess, right on the inflation risks, but for the wrong reasons. In terms of this sort of spike that we've seen, I think has been sort of greater than I expected. The conflict has been broader than I expected. But yeah,
Correct. I think
lots there.
yeah, I don't think anyone expected it to sort of widen or to sort of turn out in the manner that it did. But yeah, let's
No,
go on.
I think everybody was expecting some form of conflict. I was
Correct.
certainly thinking some form of conflict, but this is certainly broader and bigger
Well,
and more severe than I had expected. And certainly the way that it has spread over the region is broader than I expected. And again, it's a lesson in sort of being humble about the things that we don't know at the moment as well.
well said. I think if we can have the results of the poll, let's have a side. Okay. Okay, we have one which is supply chain disruptions, which is sort of taken the lead, and followed by equity market volatility. So those two sort of top of mind, if you will. And yes, some amount of concern on the other two, which is the inflation and oil and energy prices. So interesting to see what everyone is thinking. But yeah, that's the sort of response from our audience. Any surprises there, Ben?
No, actually, and I'm really, it's good to see the supply chain one popping up there actually, because supply chains are generally something that I've been writing about and thinking about for the last sort of 3 or 4 years or so, really since the sort of COVID scenario. And certainly something that I think, if we look at the broader, bigger picture of the world at the moment, is that countries around the world are trying to build a lot more resiliency into their supply chains.
Yeah.
We've been over the past sort of 30 years or so, and probably longer, in this world of a just-in-time production, sort of be as efficient as possible, get the goods right into the factory at the last minute, do something with them, and then ship them out as quickly as possible. Now that is very efficient, but it's very insecure. When something breaks, it can fall apart very quickly. And we saw that during COVID. We saw that during 2022. We're seeing it again now. And I think what that means for me is that companies around the world are going to look at these supply chains and go, we need more resiliency. We need to build more security into those supply chains. So this is something that I think, again, is going to be with us for a period of time. And it means over the medium to long term, we're in a more inflationary environment than we have been in the past. And I think it covers a wide range of areas. So it's supply chains around getting chips. It's around fertilizer at the moment, which I'm particularly concerned about and hasn't got quite as much attention in the news flow at the moment. But then it's also about the energy security side. And I think what you're going to see over the coming years is many more countries are going to try to look more inward for their energy security rather than relying on external sources. Now, perhaps that accelerates the energy transition. For example, it's more solar, it's more wind, it's more nuclear,
Absolutely.
for example. But yeah, the change in those supply chains are going to be so important, I think, for the coming years. But the final thing I'll just say on that point is that isn't necessarily a risk. It's an opportunity, because to build out those supply chains, there are opportunities there. And I think that as investors is really the thing that we need to lean into. What is the opportunity here now? Keep the more sort of open, optimistic mindset.
100%. I love the way that you framed it. I think you're absolutely right. Countries are going to be sort of looking at it a lot more inwards and trying and figuring out the alternative sources. 100%. Sumit, I see you've got something on your mind. Please
Yeah,
go
so
ahead.
I love the word opportunity. Perfect segue for the question I had for Ben. So we've spent the last couple of minutes talking about disruption, instability, uncertainty. Now, given what we are dealing with and using the word opportunity, Ben, how do you think investors can balance, short-term tactical moves, looking for opportunities in terms of pricing versus long-term strategic allocations?
Yeah,
How do you think that needs to evolve at the moment?
sure. So I think that the long-term strategic asset allocation is somewhat easier. Again, it's about building a broad, diverse portfolio. And I think the key thing I would be doing at the moment, and I was doing last year and probably the year before, is broadening out the asset allocation set. So adding other alternatives into the portfolio that are more sort of inflation hedges in the portfolio. Use
Right,
this opportunity to look at your portfolio and say, from a strategic perspective, is it going to diversify me? Is it going to protect me against the risks that I think potentially could come down the line? And I think keep in mind that the risks that are likely to come down the pipeline are going to be more of a supply nature than a demand nature. So that would be the long-term focus. The
right,
short-term focus is so much harder at the moment, and it depends on what you mean by short-term. If you mean short-term in today to tomorrow to the next day, for example, I would honestly say don't try. Do not try to sort of time those moves, because there'll be people that will. There will be traders that will. I am definitely not that person. But what we're dealing with here are personalities in the form of President Donald Trump, Bibi Netanyahu, the new Muttaba Gahimi, the supreme leader of Iran. Very unpredictable personalities. In the fog of
absolutely.
war, things can change very, very quickly. And you are going to see moves like we saw on, I think it was Monday, Tuesday, when oil moved up more than it had done in ever. It moved down more than it had done ever. You had this sort of biggest intraday
Right.
move than you've ever seen. Trying to trade that is impossible. You are going to get burnt if you do that. So I think it's sticking to the long term. Now, I think in terms of if we start to see signals that this conflict is de-escalating, if it is resolving, if we're starting to see the energy flows returning, then what I would be doing is leaning back into the views and the ideas and the trades that you and I, Smee, talked about a few weeks ago, which was
Right.
non-US markets relative to US markets. I still think the better valuation opportunities, I think the better growth opportunities now, where things are better priced, is in emerging markets, is in Europe, is in the UK, for example, rather than US markets. Remember also that a lot of those markets that I've just talked about there are focused more into the older economy side of things. They're less tech focused. And I think it's those older
Traditional
economies,
economies. Yeah.
traditional, exactly, the industrial side of things that is going to benefit from greater defense spending. There is going to be greater defense spending. That was true on January the 1st this year. It's even truer today. So leaning into those areas, I think, is absolutely key. Leaning into some of the commodity areas that, yes, have moved up a lot in recent weeks, but I think continue to move higher. So when I think about short term, I'm thinking sort of about the next sort of 6 months to a year. When I'm thinking about long term, I'm thinking 5, 10 years
Agreed.
type of
Yeah.
horizon. I'm not doing the day-to-day trading because
No speculative.
I
Yeah,
am just not
absolutely.
I am not smart enough to do that, or let's say brave enough to do that, perhaps.
No, no, absolutely. And you just spoke about defense. That was
Mm,
something I wanted to, just bring in that a lot of conversations we've been having about the spend into defense,
mm,
led underlines kind of increasing, given what's happening in the world right now, and the heightened sense of unease that has gripped the entire world, right? In terms of
yeah.
what can potentially happen. Do you feel areas like defense or any other ancillary industries which or areas or markets which where the valuations now look more attractive given what has happened?
So it's tricky on the valuation side of things, because if you were to look at European defence, for example, and I think actually European defence is a great place to be at the moment. I do think the money is going to be spent there by Germany and by others, and I think that Germany has the capacity to build out that defence structure. If you were just to objectively look at the simple PE multiples or the simple valuation multiples we attach to many of those companies, you might say they look expensive, but it depends on what earnings do. Now, I think earnings growth is going to be quite strong for these areas, which actually then suggests that these areas actually look more attractively valued. So those areas in particular, I think on traditional measures, it looks a bit challenging. but I still think there is value there in the medium term. The same, I would argue, is true of just broader industrials, which are going to be the sort of feed pipeline for those areas. The same is true of broader commodities, but particularly materials. The one I would be a little bit more nervous about at the moment, where perhaps has gone a bit too far, would be the energy side of things. So we have seen sort of energy stocks outperform significantly. Again, that sort of makes sense because they're very sensitive to the oil price. But after this move now, sort of what you've got is either this de-escalates and energy prices come down and energy stocks underperform in that scenario. Or if you've got the worst case scenario and the energy doesn't flow, then what you've got is fine higher energy prices. But if you're not shipping anything, it doesn't matter what the price is, because $150 multiplied by 0 is still 0. And I think then those companies have a bit of weakness. So I would be nervous about chasing the energy sector at the moment. You'll get some volatility, and it might be that in middle of next week the energy sector is up 10-15% or something strong, and I've been wrong on that. But it's one where the risks are too great, the volatility is going to be too great. I wouldn't want to chase it. I'd be trying to focus on things where I've got more confidence that in a couple of different outcomes or a balance of more outcomes, you're going to see these areas perform. And that's industrials, defense, for example, and actually financials as well. I think financials, again, can do well in this scenario broadly, unless we get the severe recession. If you get the severe recession, if you get the credit markets blowing out, then financials are not going to perform in that scenario. But the reason that I think that doesn't happen is because we have a very resilient, actually, backdrop. The private sector is in actually very, very good health, and partly explains one of the first questions that you asked me earlier in terms of the how have markets moved. Markets haven't moved an enormous amount. They've been relatively well ordered, and I think it is because this comes against the backdrop of a relatively resilient private sector. Companies have paid down debt, households have paid down debt, for example. We're able to absorb those shocks for a degree of a period of time. And again, that for me suggests that financials are still a decent place to be invested at the moment.
Interesting. Thank you. Anselm, over to you. We can't hear you. Sorry, you're on mute.
Yeah, my wife frequently accuses me of talking to myself. Now I know why, but
it's the only person that you get sense out of. I always say my wife says the same to me.
So yeah, but it is these things change so often, right? I mean, when we're looking at it today, whether it is the geopolitical situation, whether it is the other aspects, they can normalize just as quickly. And from your perspective, are these already priced into the market? How do you see that?
Honestly, it's very difficult to say. It is, if this normalizes, then yes, it is priced into the market. If we get the worst case scenario, then it is not priced into the market. So in the scenario that you get 15% of the world's energy supplies taken off stream, that is going to trigger a recession, because you are going to have some form of demand destruction. Now, as I sit here with you today, that is not my base case. I don't think that is going to happen. Again, with the caveat that this is very, very uncertain, and I could very easily be wrong. But the point that you make, and I'm just going to see if I can flash up a chart here. Now, I'm going to show you. Doesn't look like I can share the chart.
The team can allow that. I think just give us a second.
It's probably because I was going to share with you the worst chart in the world in terms of PowerPoint presentations. So let me share with you this. So hopefully you can see that on the screen now, and you can see my PowerPoint there. So this is 2025, the S&P 500, and you can see there are so many different words on that. If you sort of lean in and squint, it's going to confuse you. It's going to give you a headache to try to read that. Now, the reason that I show you that slide is because in 2025, so much happened. At the beginning of the year, we were worried about DeepSeek and China upending the US AI narrative. Then we had Liberation Day, huge tariffs imposed on global trading partners around the world. We had conflict in the Middle East in the middle of last year. We then had one of the longest government shutdowns that we had over the course of the US history, and many, many more things in the meantime, which is why that's such a busy chart.
Yeah.
And yet the equity market ignored it. Equity market ended the year 17% higher. So again, this is a very good lesson in the first polling question that you asked. Is sort of it's cutting through the noise and seeing the signal. Now again, this happened because economic growth continued, earnings growth continued, consumers continued to spend. There wasn't a policy mistake. Now, if any of those four things are wrong, then equities go down. If I take you just very quickly to the next slide, if I go back over the last 50 years or so and say when we've seen these geopolitical events in the past, how have they typically impacted global equities in the year subsequent? Now, for most of those, so things like 2003, US Iraq, 1990, Iraq Kuwait, for example, US Afghanistan, USR in Afghanistan in 79, for example, or indeed Yom Kippur in 1973, for the most part, global equities are higher in the subsequent 12 months because fundamentally there wasn't a policy mistake, there wasn't a significant supply shock, we didn't see sort of significant spikes in sort of oil prices. Now, what you might say to me, oh, hang on a minute, Ben, oil prices went up a lot in 2003, 2004, 2005.
Yep.
And they absolutely did. But oil supplies continued to grow. Actually, oil supply growth grew in 2003, 2004, 2005. Prices went up because economic growth was very, very strong. That was not the case in 1973. It was not the case in 2022. There was a significant supply shock. And again, this just illustrates this idea that there are these binary outcomes. If this de-escalates and there's not the supply shock, you're going to be in one of these most events. And the balance of probability says you're probably going to be in one of these events. In the worst case scenario, then you are going to get global equities lower than where they are today. So this is the tricky thing we have to balance out. So in terms of are markets pricing this at the moment, markets are pricing that we end in one of the more common. They're sort of they're balancing the probabilities and saying this is probably likely to ease, and the oil and gas is going to flow. We're certainly not pricing a 1973 or a 2022 scenario at the moment. So look, the world is in turmoil right now. There is a lot of challenge, and it's too hard to look through the noise. But I think those two charts for me suggest that oftentimes that the wars will eventually fade, the headlines will dissipate, and again, it was less than a year that we had Liberation Day. Again, a lot of that has faded. We've seen that rebound very, very quickly. And we need to sort of focus on is thinking, is there going to be a policy mistake? Are there excesses in the credit market, in the lending market? Is there going to be a misallocation of capital? Are consumers, you and I, are we all going to retrench and stop spending and tip the economy into recession? And at the moment, as I say, I'm on the more positive side of the fence at the moment, which means very much stay invested right now.
Interesting. Thank you so much for that. And I think time to get to the audience. We have one poll question before we go to some of the audience questions that have come in. I'm mindful of time. So the poll question is on your screen. Remember, you can always ask a Q&A in the chat box. I'm going to read this quickly. How would you best describe your current investment stance? I mean, we've heard from Ben. We've got a good insight into many of the different aspects of it. Are you committed to sort of staying fully invested and focused on long-term goals, selectively rebalancing, increasing defensive exposure, holding more cash temporarily, or waiting for more clarity before making changes? So I'd love to hear from all the members of the audience as to what their thoughts are on this. Ben, any thoughts on this poll question from yourself?
Well, I'm really hoping that it's the top one that comes out on top, and I'm not trying to influence well, I am trying to influence the audience because that's kind of what I've said for the last 45 minutes or so. So I'm hoping that is. I suspect there might be a little bit of selective rebalancing. What I would say is holding cash would worry me. Holding cash always worries me, particularly in a more inflationary environment, because we know that cash is going to underperform, and I know it feels safe in the short term, and to a degree it is safe in the short term. The trouble I always have with that is that you might hold cash, but then the next question is, when do you deploy it? And the best time to deploy it normally is when it feels worst, when it's hardest to actually do. And I think many investors, even the best of us, and certainly even me, will often not necessarily from a personal perspective necessarily deploy cash at the best time. So yeah, let's see what the results are. This is going to be interesting.
Yes, let's look at the results.
Woo!
There you go. I think they've been listening to you, so which is always good and positive.
Yeah.
So we've got both, which are very good. I mean, it's a good sense of the audience that they've been listening, and I think there's a depth probably built from experience that they understand that staying fully invested and focused on the long-term goals is core.
Absolutely. And look, I mean, as you've alluded to and you've highlighted with some of your questions, we've gone through a lot of these events over the last 5 years. If you think about all the things that have happened in the last 5 years, you've had COVID, you've had the Russia-Ukraine conflict, we've had this conflict, for example, and we've had Liberation Day, for example. And over that period, all of these have suggested that what you want to be doing is staying invested for the long term. And a lot of times it's the short term pullbacks that you see in markets really are short term. So if you're trying to build wealth and build portfolios for the next 5, 10, 20 years, then I think definitely staying invested is the right thing to do from my perspective.
Fantastic. We've got two questions that we're going to we've picked from the audience, and then we'll go to closing remarks. So if we could have the first question on the screen, please, so that we can get Ben to comment on it. There we go. This is a question. Due to the current situation, should we increase allocation to safe assets like gold, bonds, or even oil now? Ben?
This is a really good question, and you could look at each of those three and say, well, I maybe don't want to allocate to each of those three because of where the prices are at the moment. So particularly on gold, for example, we know that gold moved up an awful lot last year. It's continued to perform well this year, as has something like silver. But I think gold does have a place in the portfolio now. It does have that lower correlation over the medium term with traditional conventional assets. So yes, I think gold and some broader commodities have a place in the portfolio today. I think bonds less so, and I would not be taking the duration risk at the moment because I think those inflation pressures are going to keep pressure on bonds. So have some fixed income in the portfolio, but think about it from a income perspective. Don't think about it as the safe haven asset that is going to diversify you, because I do not think it's going to diversify you against this type of shock. So yes, you can have some credit, yes, you can have some high yield, yes, you can have some EM bonds, but think about it from the income perspective. And then oil, I mean, look, oil has moved a long way. Now, again, I could paint a picture that says to you today that oil is going to be at $200 in 2 weeks' time. I could paint a picture that says oil is going to be at $70 in 2 weeks' time. There are two binary outcomes. I personally would not have a big position in oil markets in either a positive or a negative fashion. I would not be taking that bet at the moment, because it's such a binary outcome and you could lose heavily on both sides. I just do not have the confidence in saying that. So I think of the three that you put up there, it's gold is the one where I would say probably perhaps increase the allocation, because if I look at the broad allocation that I know investors globally as a whole have, it's still very low to those precious metals areas. The gold ETF market, for example, is about 350 times smaller than the global equity market. So a little bit of a flow into gold perhaps can actually have a big impact on that market. So of those three, gold would be the one.
Thank you for that. I think we've got one more question. If we can have that up on screen. One more question that we're taking now. I think we're almost at the end of the session. So With the recent market drop, should we be buying more or I love this. Or
I
waiting
love
for a
this
further
question.
dip in your opinion? How far do you think equity markets can fall if trades remain closed for another 2, 3 weeks? All right, over to you, Ben.
So all with the easy questions, thank you. Yeah, look, I think it depends on your time horizon, your appetite for risk, and your opinion of what you think is going to happen in terms of the escalation and de-escalation. If the Strait of Hormuz is remain closed for another 2 to 3 weeks, then equity markets are going to move lower from here. The degree to how much they're going to move lower from here is really then does the Strait of Hormuz stay closed for another, or the expectations of it, is that going to run into months? If it's going to run into months, we are going to have a more significant drawdown. You're looking at the sort of the 15-20% drawdown in global equities, I suspect, if you're running into the months, unfortunately. And I don't like to say that, but I think that is probably true. If we're in an environment where you start to get a gradual flowing of some ships through the region, and the east-west pipeline, for example, from Saudi Arabia, the oil is flowing, and you get sort of reduced conflict between the US and Iran, I think that's the environment where markets are then going to start to grind higher, and I think you could sort of buy the dip on this. What I would say, and again, I will give you my own personal sort of view in terms of what I'm doing myself, and I do this from a personal perspective, is I'm just not sticking to my normal way of allocation, which is continue to add money into the market on a regular basis, on sort of a monthly basis. I'm not changing that strategy, and the way that sort of dollar cost averaging into the market allows me to say is, well, if we get a dip, I'm buying on those dips, but I'm not sort of pumping a big chunk of money in right now. I think it's that dollar cost averaging in this environment, I think, can help you with the emotional side of things. And you might look back and think, oh, that was a great buying opportunity. I did get in at good prices. But equally, if you get some further weakness in the subsequent months, it doesn't matter, because you're investing for the next 15 years. And if you then look back in 15 years, you will probably not be able to spot the drawdown that you see on that long-term chart. So yeah, look, again, it's back to the things I mentioned earlier. The uncertainties over the immediate term are very, very wide right now. We could very easily be back in very positive markets in a few weeks' time, and we could all be talking. And let's really hope we are that you guys want to host a webinar in a month's time where we're talking about AI and software companies and the Citrini paper, for example, because if we're talking and worrying about that, we're not worrying about this.
Couldn't agree with you more. I think that's we'd love to be able to host not just a webinar, but a seminar in person with all of our clients coming in and talking about the opportunities that are available to everyone here.
Absolutely, yeah.
Quick.
Well, that's a very good point. I would love to be out there in person with you
There
doing this, and as soon as the travel restrictions opening up, I absolutely will be there. And again, from so many perspectives, I really hope that is the case sooner rather than later.
Absolutely. We're almost we're surprisingly well on time, and I'm going to go to both you and Sumit for closing comments. Sumit, I'll go to you first. Closing thoughts, things that
Sure.
stand out.
Thank you.
One
Absolutely.
takeaway,
Thank
if
you
you
so
have to.
much. Yeah. Just one thing is that we've spoken about it throughout. Lots is happening, lots of disruption, lots of uncertainty, but the good old principles of investing stay on track. Don't try to time the markets. Don't get into speculative positions, and use dollar cost averaging if you're looking at further dips in the market, since we can't really time how it's going to play out. So that in a nutshell. Over to you, Ben.
I think you summarized that absolutely perfectly. I think that's exactly it's about not panicking. That's the absolute key here, and sticking to the process and focusing on the long term, because as much as it might be exciting and attractive to try to make money in the short term around these sort of trades, I think even the best of us, even the people that are watching this closely and have even more expertise on the geopolitics and the politics and the history of this region, it's very, very difficult to time, and I think you will get burnt. So I think very much stick to the long term, stay invested. That's definitely the lesson that we take from history over the last really sort of more than 100 years or so, is that this too will pass. This will ultimately, as difficult as it sounds, fade from memory, and we will look back and say, I can't see that on a chart. Just stay invested is the key message from my perspective.
Perfect. Love that. I think that is a perfect note to sort of close things out. This too shall pass. Stay calm, stay vigilant. Look at the markets, look at the opportunities that are there that are going to present themselves, and we will come out and emerge a lot more stronger. So,
Yes.
thank you very much, Ben, for your time, for your insight, for sharing that with us and with our team members. Thank you, Sumit, and thank you, Michelle, as well. And thank you to all of our audience members, to every one of our colleagues and clients who've joined the call, for listening to us and sharing your thoughts with us as well. So have a wonderful day and all the very best. If there are any questions that you have, feel free to drop a note either in the chat or in the comments, or to us and the team members. There's a poll question, or there is a survey at the end of once you exit this. Please do share your feedback with us. Once again, thank you.